Hi! Welcome to our new topic in financial accounting and reporting. After learning what the accounting equation is and how it is perfectly mirrored by the balance sheet, we will now discuss the contents of the financial statements. The income statement, the statement of changes in equity, and the balance sheet all contain details about the performance and financial position of the entity, summarized in what is known as the account. Our discussion will start with locating where in the financial statements are the accounts. As we have done in the previous chapter, we will again use the balance sheet as our anchor point. After locating the accounts, we will then discuss the definition and characteristics of the account, what the types of accounts are, the life cycle of accounts. Then, we will discuss what balances are and the kinds of balances. We will then dive deep into the chart of accounts, or COA, which is basically the repository of all accounts used by an entity. This topic has three subtopics, namely, classification hierarchy, general ledger, account coding and common accounts used and how they are measured and presented in the financial statements. From the chart of accounts, we will also discuss the best practices in maintaining a chart of account in the digital age, incorporating information technology in accounting practices. As always, in the practice of accountancy, we should remember to be professional, perform effectively and efficiently, follow standards, and document our work adequately and properly.
Locating accounts and the FS. Again, let's take off with our discussion from the balance sheet of a fictitious business entity we will call a ABC company. Here is ABC's balance sheet in the account format. On the left of the report is the asset and on the right are the liabilities and owner's equity. Again, we call them, in reference to the accounting equation, elements. We may also call them the main categories of accounts. Under these elements we have captions like current assets, fixed assets, current liabilities, and so on. These we call classifications or groups of accounts.
What is account? Under the groups, we can see titles such as cash, accounts receivable, and inventory under assets, and on the right side, we have accounts payable, short-term loans, and so on. You will notice that there are numbers across these titles. These are what we call accounts. An account is the basic unit for systematically recording and tracking financial transactions related to a specific asset, liability, equity, revenue, or expense. Think of an account as a way to keep track of your money, like a personal ledger, but for businesses. It's basically a record of all the financial stuff that happens, whether it's related to what you own or assets, what you owe or liabilities, your worth or equity, the money you make or revenue, or what you spend or expenses. Now, every time something happens financially, it affects at least two accounts, kind of like a seesaw. This is because of the double entry system, which uses debits and credits. You've got to have at least one debit and one credit for every transaction, but you can have more than one debit entries and more than one credit entries. If you only have one debit and one credit, we call that a simple entry. Otherwise, it's called a compound entry. Whether you use a simple or compound entry depends on the type and complexity of the transaction. But the thing to remember is, you always have to ensure that the total debits will equal the total credits. Otherwise, your accounting equation will not be balanced, and you'll have a ton of headache backtracking on your work to find where you went wrong.
Types of account. In accounting, accounts are basically split into two main types, temporary and permanent. It's like having two different kinds of notebooks for keeping track of your money. Temporary or nominal accounts are like a notepad you use for a specific period, like a month or a year. Once the period is over, you clear the notepad and start fresh. These accounts track things like your income and expenses to see how well you're doing financially during that specific period. Think of it like tracking how much you made from sales, how much you spent on rent, or if you had any unexpected losses. At the end of the accounting period, These balances are transferred over to the equity in the balance sheet, and they all start at zero again for the new period. Examples of temporary accounts include revenue accounts like sales revenue and service revenue, expense accounts like rent expense and salaries expense, as well as gains, losses, and dividends. Permanent or real accounts, on the other hand, are like a master ledger that never gets cleared. These accounts are the stuff of the accounting equation and the balance sheet. They show the company's financial health, and they keep going from one period to the next. They include what you own, or assets, what you owe, or liabilities, and your overall worth, or equity. Examples of permanent accounts include assets like cash, accounts receivable, and equipment, liabilities like accounts payable and loans payable, and equity like retained earnings and common stock. The big difference is that temporary accounts are all about measuring your performance and they go on the income statement, whereas permanent accounts show your financial position and go on the balance sheet. Temporary accounts track your income and expenses for a specific period, while permanent accounts show how well you're doing long-term. It's super important to know the difference between these accounts for clear and accurate financial reports.
Lifecycle of accounts. The life of every account goes through a cycle. Temporary of income statement accounts always start with a zero balance, then it records new transactions, makes adjustments at the end of a period, and finally closes or returns to a zero balance when the amounts are transferred to the equity account of the balance sheet. And that's how it got its classification as temporary. Kind of like putting in your bank account what's left of your salary after all your expenses. Permanent or balance sheet account starts with the leftover balance from before, which may be zero, then it records new transactions, makes adjustments at the end of a period, and finally closes at the end of the period with the ending balance, which, again, may be, not necessarily, zero. Permanent accounts become absolutely zero only when the entity decides to terminate its business activities, sell its assets, and distribute the proceeds of the sale to creditors, lenders, and finally the owners. All the accounts are connected, so if you change one, it'll affect the others to keep everything balanced.
Account balances. At its heart, an account balance is the difference between the total debits and credits in an account at any specific time. Basically, it's like a running tally of all the money coming in and out of an account. To better understand, let's look again at the current assets section of EBC's balance sheet, specifically the cash account. There are a few things that make up the account balance, including beginning balance. This is simply how much money was in the account at the start of a period, carried over from the last time. Current transactions. These are the new credits and debits that happen during the current period. Running balance. This is where it gets interesting. It's a constantly updated balance that changes each time a new transaction is recorded. So after each debit or credit, the balance is recalculated, and it reflects the current financial position. The running balance is especially important because it's continuously updated. This real-time updating means you always know exactly where the account stands. It shows how individual transactions impact the overall account balance. You can see each specific transaction and how it changes the balance. It provides a real-time snapshot of the account status at any point. This is crucial for monitoring your finances and is a major reason why it's a useful accounting concept. Running balances also help you monitor account activity, spot errors easily, manage cash flow better, and reconcile your records. Finally, the ending balance is just the final amount you end up with after all the transactions. This amount is reported in the financial statements. So, in short, the concept of account balance, especially the running balance, is not just a number, but a vital tool for keeping track of a business's financial status in real time. It's like having a financial GPS that makes sure you know exactly how your accounts are doing.
Kinds of account balances. There are three kinds of account balances: A debit balance means you have more debits than credits, like having more money going out than coming in. A credit balance means you have more credits than debits, like having more money coming in than going out. And a zero balance means your debits and credits are exactly equal, like a perfectly balanced scale. It's useful to know that assets and expenses typically have debit balances, while liabilities, equity, and revenue usually have credit balances. It's like each of these categories has its own natural lien, and this is what is known as the normal balance of an account. When an account's balance is abnormal, or it is not on its proper lien, then you know you did something wrong earlier, and you get a ton of headache once more.
The chart of accounts. So, now you might ask, where does an entity keep a list of all the account it uses to record its financial transactions? Well, entities keep a list of all the accounts they use in a chart of accounts. Or COA, the chart of account is like the financial backbone of a company, keeping track of all the money stuff. Majority of business entities that are either a sole proprietor, partnership or corporation are free to create their own charts of accounts. However, the cooperative businesses are heavily regulated, and part of the control mechanism is the mandatory adoption of a CDA-designed chart of accounts. On the slide is the revised standard chart of accounts for cooperatives approved by the CDA on September 5, 2022. Shown is the first section of the chart. Here's how a chart of accounts works in general. It categorizes everything into 5 main groups: assets, liabilities, equity, revenue, and costs. These categories help show different parts of the company's financial health. It uses a numbering or coding system to help accountants find and organize transactions quickly. A good COA makes sure all transactions are properly classified for financial statements, like the balance sheet, income statement, and cash flow statement. Except for cooperatives, it's also customizable. It can change based on the company's size, industry, and what it needs to report. For example, a retail business might have a lot of detail in its cost of goods sold, or COGS accounts to track inventory, while a manufacturer might have specific accounts for raw materials and such. The COA is adaptable to a growing business, and it's good to check and update it as the company changes. Why is COA so important? Well, a solid COA helps with accurate financial reporting, making sure all transactions are classified correctly for financial statements, budgeting and decision-making, helping management track expenses, control costs, and make financial predictions. Regulatory compliance, helping businesses follow accounting standards like GAAP and IFRS, and tax rules and keep up with regulations by keeping accurate and clear financial records. A COA ensures financial data is organized for calculating taxable income and claiming deductions, and is also very helpful during tax audits. Audit efficiency, making internal and external audits easier because everything is organized. Consistency, keeping the same structure over time is essential for reliable financial data and allows for good comparisons over time. Scalability and customization, it can grow as the business does and can be tailored to specific industry needs. Different industries might also structure their COAs differently, like retail, manufacturing, service, or nonprofits. In short, a good COA is the base for good financial management, ensuring that all transactions are recorded correctly to help with financial analysis, budgeting, compliance, and making good decisions.
Account classification hierarchy. As we have seen, there are 5 primary categories or elements in the chart of accounts. From the balance sheet, we have assets, liabilities, equity. And from the income statement, we have revenue or income and costs and expenses. Next, each of those main categories gets split into classifications or groups or subcategories, which give you more details. For assets, you've got current assets, which are things that are used or turned into cash within a year, like cash or inventory, and non-current assets, also called fixed assets, which are things that are held for more than a year, like buildings or equipment. For liabilities, you've got current liabilities, which are due within a year, like accounts payable, and non-current liabilities, which are due in more than a year, like long-term debt. Equity, which is usually called owner's equity or shareholders' equity, and for cooperatives, it is called members' equity. Equity includes things like common stock, retained earnings, and additional paid-in capital. For cooperatives, there are a heap more accounts under equity, including restricted capital for surety, fund balance, undivided net surplus, net loss, which weirdly has the same account code as undivided net surplus, donations, grants, statutory funds, which are mandatory funds established, set up in accordance with Article 86 of RA 95-0, revaluation surplus, and unrealized gains, losses on investments. Under the statement of operations or income statement, we have revenue or income is broken down into operating revenue, which is income from the company's main business, like sales, and non-operating revenue, which is income from things outside the regular business, like interest from investments. Costs are classified into cost of goods sold if the cooperative is engaged in merchandising, or cost of services if it is in the service industry. Cost of services are further separated into project management cost, which are costs incurred that are directly related to the projects and contract entered into by clients, like manpower servicing, construction, and other professional works, including consulting fee. Generation and distribution costs, which is costs specific to entities engaged in the distribution of power, water, and other utilities. And lastly, transport service cost, which are costs incurred that are directly related to service income and passengers' fee of a cooperative engaged in the transportation business. Expenses, which are the costs of running the main business, are listed next. These are classified into financing cost, which are expenses related to borrowings of funds used for operations. Selling, marketing cost, incurred in the promotion, distribution, and selling of products and services of the cooperatives. And lastly, administrative cost, or expenses incurred related to general administration and management of the cooperative. Finally, at the lowest level, you have the individual accounts, which record every single transaction that happens. They're like the most detailed records that fit into all the higher categories. These accounts are listed in the general ledger and carry the amounts of the transactions. In summary, this listing system of the chart of account makes sure that all financial data is recorded clearly and accurately. It is organized from broad categories to specific details, allowing businesses to track their financial performance and position over time.
The General Ledger. We mentioned the term General Ledger. A General Ledger, or GL, is basically the heart of a company's accounting system. It's where all the financial transactions are recorded and categorized, helping keep everything organized. Think of it as a big, detailed record of everything that happens financially within the business. Each transaction is entered as a journal entry, which includes debits and credits for the appropriate accounts, whether it's assets, liabilities, equity, revenue, or expenses. These entries are typically organized in a T account format, where debits go on the left and credits go on the right. The General Ledger is essential because it facilitates the preparation of the financial statements. It also acts as an audit trail, making it easier to verify transactions, and helps with account reconciliation by making sure everything adds up correctly. For example, if a business makes a $65,864 in cash sale, the General Ledger will record it by increasing both the cash account debit and the sales revenue account credit. Essentially, the general ledger keeps everything in check and ensures that all the company's financial data is accurate and accessible. Account coding. Okay, let's talk about how account numbers are coded and the usual structure of the code. In actual business setting, especially if the entity employs information technology, or IT, to process transactions, each account in the chart of account gets its own unique number. Think of it like an ID number for each category and account. This makes it super easy to keep track of all the different types of money coming in and going out. The coding system itself is usually pretty clever. Here's how it generally breaks down. You might see 3 to 5 digits used in these systems. It's not too long, so it's manageable, but also long enough to allow for enough individual accounts to be tracked. Again, let's take a look at the cash account from the cooperative's chart of accounts. The first digit, 1, is like a big category indicator. This digit means that the account is an asset. A 2 indicates it's a liability. 3 is equity, 4 is revenue and income, 5 is costs of goods sold, 6 is cost of services, 7 is expenses, 8 is other items of income or losses, and 9 is income tax expense. This way, just by glancing at the first digit, you have a general idea of what kind of account it is. Then, these numbers allow for logical organization and grouping. This means similar types of accounts are kept close together, which helps with managing and analyzing financial information. For example, the next digit of the code indicates the group of accounts. Under Assets, codes 1 and 2 indicate a current asset. Codes 3 to 7 indicates a non-current asset, and 8 indicates that the account belongs to other non-current assets group. The third digit might be used to indicate a subgroup. The CDA chart of accounts assigned 1 for cash and cash equivalents, 2 and 3 for loans and receivables, 4 for other financial assets, 5 for inventories, and 6 for other current assets, such as prepaid expenses. The last 2 digits might be used to indicate the account level itself. The CDA chart of accounts assigned 10 as cash on hand, 20 for checks and other cash items, 30 as cash in bank, 40 for cash in cooperative federation, 50 for petty cash fund, 60 as revolving fund, 70 as change fund, 80 for ATM fund, and 90 for e-wallet fund. Thus, in our analysis of the account code assigned to the cash account of cooperatives, we understood that the code is a deliberate design and it's not about just randomly assigning numbers. Why is this all so important? Well, it's all about creating a well-organized financial system. It's like organizing your sock drawer. You could just throw everything in there, or you could separate them by type and color. The same goes for accounts. Having a structured numbering system is way more efficient. Some benefits of coding include: it makes it easier to find and reference specific accounts. If you need to check how much cash the company has, you just look for the cash account number. It helps make sure the accounting records are consistent and accurate. With everyone using the same system, you reduce the chance of mix-ups and mistakes. It makes it easier to prepare financial statements. When everything is clearly categorized, it's much simpler to pull together the numbers you need to see how the business is doing. The accounts in the chart of accounts are used in the double entry bookkeeping system, where every transaction impacts at least 2 accounts. By using a structured coding system for account numbers, businesses can get a really good handle on their financials, which helps with making sound financial decisions, as discussed before. So, at the end of the day, these account codes aren't just about numbers. They are a key part of how businesses keep their financial houses in order and make sure they are doing things accurately, consistently, and in an easy way to follow.
Commonly used accounts. Now, let's look at some common accounts that entities generally use. To cover the cooperative perspective, note that some of the accounts that we will encounter are also found in the revised chart of accounts for cooperatives as of 2022, issued by the Cooperative Development Authority. A. Asset accounts. Let's start with balance sheet assets. Like we learned from the previous chapter, basically asset accounts are all about the stuff that a business owns. Think of them as the resources that a company uses to run its operations and make money. These assets can be anything from cash to equipment. Current assets. Within the broad category of assets, there are different types like current assets. These are the resources an entity expects to use up or turn into cash within a year or the normal operating cycle of the business, whichever is longer. Current assets are crucial for day-to-day operations and making sure a company has enough money on hand. When a company first gets a current asset, it is recorded at its initial cost, including the price and any extra cost to get it ready for use, like shipping or setup fees. Some commonly used current assets are: cash is pretty straightforward. It's recorded at its face value. Accounts receivable are recorded at the amount of the invoice, but this is reduced to account for potential bad debts using an allowance for doubtful accounts. Inventory is a bit more complex, as it is valued at the lower of either its cost or its net realizable value, NRV, which is the estimated selling price minus any cost to sell. There are different ways to figure out the cost of inventory, such as FIFO, first in, first out, LIFO, last in, first out, or weighted average cost. Prepaid expenses are recorded at the amount paid and then expensed over the period that they benefit the company. Current assets are presented in the assets section of the balance sheet, typically listed in order of liquidity. This allows stakeholders to quickly assess the company's short-term financial position and ability to meet its current obligations. An example of current assets presentation is provided here. Next up are non-current assets, also known as fixed assets, long-term assets, or property, plant, and equipment, or PPE. As we have learned, these are the long-term tangible assets that a business owns and uses to generate income. These assets aren't expected to be turned into cash within a year, or even within one operating cycle. They are used in business operations for more than 1 year, so they're definitely in it for the long haul. How is the accounting treatment for non-current assets? They are initially recorded at their initial cost, which includes the purchase price and any expenses it takes to get them ready to go, like delivery and installation. Because of their acquisition cost or cost to buy, they are usually a pretty big investment for the company. Here are some commonly known account subgroups of non-current asset. Property, like land and buildings that the company owns. Plant and equipment, like machinery and production gear. Vehicles, such as company-owned cars and trucks. Furniture and fixtures, like office equipment and furniture. Under these classes, some more specific accounts, and these could be a short, long, or very long list depending on the type of business. For example, the chart of accounts issued by the Cooperative Development Authority lists some 50 accounts under non-current assets. Most of these assets, except for land, lose value over time due to wear and tear or becoming outdated. This loss of value is called depreciation for tangible assets and amortization for intangible assets. For tangible assets like buildings or machinery, companies commonly use methods like straight-line depreciation or declining balance. For intangible assets like patents or copyrights, they usually use a straight-line amortization approach. The non-current assets accounts are presented on the balance sheet, usually subgrouped. The actual grouping really depends on the type and size of the entity and the volume and complexity of the transactions of the entity. Shown here is an example of a balance sheet showing the non-current assets section. Note that in the above balance sheet of Jollibee, the non-current assets are present net of depreciation and amortization. The net presentation after depreciation and amortization helps provide a more accurate representation of the asset's remaining value and its contribution to the business, which is essential for assessing the company's financial position and performance. The last class of accounts under assets are what is termed other non-current assets. Basically, these are the long-term resources that a company owns that don't fit into the usual categories of property, plant, and equipment, PP&E, intangible assets or long-term investments. Think of them as assets that will benefit the company for more than a year but don't contribute directly to day-to-day operations like traditional non-current assets. Here are some commonly used other non-current assets accounts. Long-term prepaid expenses. These are payments made for services or goods that will be received over a period longer than a year. Think of multi-year insurance premiums or long-term leases. Deferred tax assets. These come up when a company has paid more taxes than it owes. The extra payment can be used to reduce future tax bills. Long-term receivables. This is money that is owed to the company but won't be paid back for more than a year, such as loans to employees or other companies. Goodwill. This is the value of a company's reputation, customer base, or other intangible things that come about when a business is bought. It's basically the extra amount paid above the fair value of the assets and liabilities that can be identified. Other long-term investments. These are investments held for more than a year, but are not the typical stocks or bonds. Examples include real estate held for appreciation or long-term stakes in other companies. In a nutshell, other non-current assets are like a catch-all for any long-term resources that don't fit neatly into the other asset categories. The accounting treatment and financial statement presentation for other non-current assets is basically the same as that for non-current assets.
B. Liability accounts. Next to assets, let's look at some common liability accounts that entities use. Like we learned from the previous chapter, basically, liability accounts are all about the stuff that a business owes to third parties. Current liabilities. The first group of accounts under liabilities are the current liabilities. Basically, these are like a company's short-term IOUs, the debts it needs to handle within a year or its normal operating cycle, whichever is longer. These usually pop up from the day-to-day grind of running a business, like buying supplies, paying workers, and taking care of taxes. Think of them as the bills you need to pay to keep the lights on. They are legal obligations that are usually settled using the company's current assets, like cash or money owed by customers. Many of these debts, like accounts payable, don't accrue interest, unlike long-term loans. Managing these well is super important for a company's ability to pay its bills. Entities also keep a close watch on current liabilities to make sure they're financially healthy. When it comes to accounting, current liabilities are recognized when a company has an obligation from a past event that will require it to use its assets within a short time. They're usually recorded at the amount the company expects to pay. For instance, accounts payable and accrued expenses are recorded at the agreed-upon amounts. Short-term loans are recorded at the principal amount due, along with any interest that's due soon. Some common examples of current liabilities include accounts payable, which are money owed to suppliers, short-term loans, or debts due within a year, including a portion of long-term debt that is due within the next 12 months. Accrued expenses. These are costs that have been incurred but not yet paid. Unearned revenue, representing money received in advance for goods or services that will be delivered in the future, and income tax payable, which are taxes owed to the government, usually payable in cash. Current liabilities are listed on the balance sheet in the current liabilities section, usually in order of when they are due, separate from the company's long-term debts. Here is an example of Jollibee Food Corporation's balance sheet, with current liabilities highlighted. Non-current liabilities. As in the case of assets where we have current and non-current asset accounts. The liabilities element of the accounting equation also has its non-current liabilities accounts. In essence, these are a company's long-term financial obligations that aren't due within the next year. Think of them as the company's longer-term debts or commitments that stretch out over several years. These liabilities are super important for funding big projects and expansions. They play a big role in the long-term growth and stability of the business. A few key things to keep in mind about non-current liabilities are that they are often linked to financing arrangements, like long-term loans and bonds, used to fund major investments or expansions. These liabilities usually come with interest costs and have scheduled repayment plans over several years. Entities handle non-current liabilities in their books through specific accounting treatments to ensure accurate reporting and compliance. Initial recognition occurs when a company first incurs a non-current liability, recording it at its fair value, usually the present value of future cash outflows. For example, if a company takes out a loan, the principal amount is recorded. Measurement after recognition involves adjusting the liability over time, typically at amortized cost using the effective interest method. This ensures that interest expenses are recognized each year, and the principal is reduced as payments are made. Some commonly used accounts under non-current liabilities include long-term loans, which are loans that are due for repayment beyond 1 year. For example, a company might take out a 5-year loan for expansion. Bonds, payable, which are debt securities issued to raise funds. These bonds have a maturity of more than 1 year, and the company makes regular interest payments until the principal is repaid at maturity. Deferred tax liabilities, which are taxes that a company will owe in the future, typically from temporary differences between accounting and tax treatments. Pension liabilities, which are obligations to pay pensions to employees after retirement. Lease liabilities, which are the present value of lease payments due beyond the next 12 months for leases lasting more than 1 year. Long-term provisions, such as those for warranties or environmental cleanup that the company expects to pay beyond the short term. Amortization and revaluation may apply to certain liabilities, such as bonds, where any premiums or discounts are spread out over the bond's life. Lease liabilities are similarly recognized and reduced through payments, with interest charged to the income statement. On the balance sheet, non-current liabilities are listed separately from current liabilities and categorized by their nature, such as long-term loans, bonds, payable, or deferred tax liabilities. Notes in the financial statements provide details about these liabilities, including maturity dates, interest rates, and repayment terms. Again, here is Jollibee Food Corporation's balance sheet, with the non-current liabilities section highlighted. Managing non-current liabilities ensures the business remains financially healthy and able to invest in future growth. It helps the company strike a balance between handling its long-term debts and generating profits, maintaining enough cash, and building confidence with investors.
See equity accounts. Finally, let's talk about the last element of the accounting equation and balance sheet: equity. Think of equity as the ownership stake in a company. Recall what we have learned in the previous chapter about equity. It's what's left over after you subtract all the company's debts, liabilities, from its assets. Essentially, it's how much of the company belongs to its owners or shareholders. Equity is a crucial part of a company's financial structure, and it appears farthest right on the balance sheet in account format. Equity comes from a couple of places: the money owners put into the company, or contributed capital, and the profits the company has made over time that haven't been paid out, or retained earnings. The accounting treatment for equity involves recognizing, measuring, and reporting the ownership interest in a business, which represents the residual value of assets after deducting liabilities. Initial recognition occurs when equity is raised through the issuance of shares, which are recorded at their par value, with any excess recognized as additional paid-in capital. Retained earnings represent cumulative profits not distributed as dividends and are adjusted periodically for net income or losses and dividend payouts. Reserves, such as revaluation reserves or statutory reserves, created for specific purposes and must be reported separately. Let's look at the different types of equity accounts. Owner's capital, or contributed capital. This is the money or assets that owners or shareholders have invested in the company. If it's a sole proprietorship or partnership, it's usually called owner's equity. For corporations, it is called shareholders' equity, and for cooperatives, it's called members' equity. For example, when someone buys shares in a company, that money goes into contributed capital. Contributed capital may either be common. This is the basic type of equity for corporations and cooperatives, where shareholders have voting rights and may receive dividends. For example, if a corporation issues 10,000 shares at 50 pesos each, 500,000 pesos is recorded as common stock. Preferred. These shareholders get priority over common stockholders for dividends and liquidation distributions, but usually don't have voting rights. For example, if a corporation issues 1,000 shares of preferred stock at 100 pesos each, it results in 100,000 pesos in preferred stock. Retained earnings. These are the profits a company has made and kept instead of distributing them as dividends. This money is used for reinvestment or to cover future losses. For example, if a company makes 100,000 pesos profit and gives out 20,000 pesos in dividends, the remaining 80,000 pesos goes into retained earnings. Additional paid-in capital, or share premium. This is when shareholders pay more for shares than their face value or par value. For example, if a share has a par value of 1 peso and the company sells it for 10 pesos, the extra 9 pesos is additional paid-in capital. Treasury stock. This is when a company buys back its own shares. These shares are no longer considered outstanding and do not have voting rights or dividend entitlements. For example, if a company buys back 1,000 shares, those shares become treasury stock. Dividends declared. Although dividends aren't an equity account, when a company declares them, it reduces the retained earnings because they represent the distribution of profits to shareholders. For example, if a company declares a 1 peso dividend per share, the retained earnings account is reduced accordingly. Other comprehensive income, or OCI. This includes gains and losses that aren't included in the regular profit and loss statement. For example, unrealized gains from investments are reported under OCI. Other equity accounts used exclusively by cooperatives. Statutory funds. In a cooperative entity, this refers to the reserves or funds that a cooperative is required by law, or its governing regulations, to set aside from its profits for specific purposes. These funds are typically established to ensure the long-term financial stability of the cooperative and to comply with legal and regulatory requirements. Statutory funds are crucial for safeguarding the cooperative's ability to meet its obligations, support its operations, and protect the interests of its members. According to the CDA Chart of Accounts, there are 4 statutory funds for cooperative entities. These are Reserve Fund, which refers to the amount set aside annually for the stability of the cooperative, equivalent to at least 10% of net surplus, and to meet net operating losses in its operation. A corresponding fund should be set up either in the form of time deposit with local banks or government securities. Cooperative Education and Training Fund. These are amounts retained by the cooperative, which shall not be more than 10% of the net surplus, for the training, development, and other similar cooperative activities, geared towards the growth of the cooperative movement. Half of the amount allocated for the fund annually shall be spent by the cooperative for their own education and training purposes, while the other half shall be remitted to a union or federation chosen by the cooperative. Community Development Fund. This account refers to the fund set aside from the net surplus, which should not be less than 3% for projects and/or activities that will benefit the community where the cooperative operates. Optional Fund. This refers to the fund set aside from the net surplus not exceeding 7%. It shall be used for acquisition of land and/or building, machinery and equipment, replacement fund for PPE, members' benefits, and other necessary funds. A corresponding fund should be set up with local banks and shall be used in accordance with approved plans and budget. Equity is the ownership value in a company and is made up of contributed capital, retained earnings, and other reserves. It's a good way to gauge a company's financial health and potential for growth. Keeping track of equity is important for investors, creditors, and the company itself to understand its financial position. Equity is presented under the equity section of the balance sheet, detailing various components to provide a transparent view of the company's ownership structure. And here is Jollibee Food Corporation's equity section of its balance sheet. Changes in equity, such as share issuance, dividends, or revaluation gains, captured in the Statement of Changes in Equity, offering insights into how equity has evolved over time. Jollibee Food Corporation's SCE is quite complex, so I will show instead the equity section of Card Employees Multipurpose Cooperative. So, there you go with the commonly used accounts usually found in the balance sheet. In the module, there is a link to a Google Sheet file summarizing the account categories, their accounting treatment, and financial statement presentation.
D. Revenue and income accounts. Switching over to the income statement elements, here we find the revenue and income and cost and expense accounts. Let's first discuss revenue and income. There are basically 2 types of revenue, operating and non-operating. Operating revenue refers to the income generated from a company's core business activities, such as sales of goods or services directly related to its primary operations. Non-operating revenue refers to income generated from activities outside a company's core business operations, such as interest income, dividends, asset sales, or rental income from extra building space and entity leases to tenants. Thus, a revenue or income is either operating or non-operating depending on the nature of the core business of the entity. In our classroom discussion, we will refer revenue to operating revenue and income to non-operating revenue. Revenue is primarily money a business makes from doing core activities of the business. Think of it as the income from its main hustle, like selling products or offering services. If you're selling cupcakes, your revenue is from cupcake sales. If you're a tutoring service, your revenue comes from tutoring. The money is considered revenue when you've done what you promised your customer, meaning you've given them the goods or services. This could be all at once, like when you deliver a package, or over time, like with a construction project that takes a while. Also, revenue is measured and recorded at what it's really worth after taking into account any discounts or returns. What's it worth usually means at the price that the company expects to get. How much revenue you make depends on the type of business, the industry, and how things are done in that specific company. When it comes to actually recording revenue, it follows a set of steps called the 5-step model. These steps include identifying the customer contract, what you promised to deliver, the agreed-upon price, allocating that price to different parts of the deal, and finally, when the revenue is recorded after the delivery is completed. Some commonly used revenue accounts are as follows. Sales. This is a general term used by merchandising entities. Sales can be categorized into cash sales, where payment is made immediately, and credit sales, where customers pay at a later date. In financial reporting, sales are often presented as gross sales before accounting for discounts, returns, and allowances, which are then deducted to arrive at net sales. Service income. This is a general term used by service entities. It refers to the revenue a business earns from providing services to its customers rather than selling physical products. Some specific type of service income include commission. This is revenue from facilitating sales or transactions on behalf of another party, usually calculated as a percentage of the transaction value or a fixed fee. Consulting fees. This is revenue from providing expert advice or specialized services in areas such as management, finance, technology, marketing, and law. Interest. This is revenue from lending money, holding interest-bearing financial assets, or maintaining deposits in interest-generating accounts. Royalties. This is revenue from granting permission to another party to use the company's intellectual property, such as patents, trademarks, copyrights, or natural resources, typically in exchange for ongoing payments based on usage or sales. Licensing fees. This is revenue from allowing others to use intellectual property, such as software, patents, trademarks, or proprietary technology. It is sometimes a non-recurring fee prior to generating royalties. Franchise fees. This is revenue earned by franchisors from granting the right to use their brand, business model, or products to franchisees. Rental income. This is a general term used by service entities that earn revenue by leasing or renting out property, real estate, or equipment to another party. Subscription fees. This is revenue from ongoing services provided on a recurring basis, such as magazine subscriptions, software as a service SaaS, or membership programs. Maintenance fees. This is revenue from offering repair, maintenance, or ongoing support services for products or systems. Training fees. This is revenue from providing training or educational services, such as corporate training programs or workshops. Advertising revenue. This is revenue from providing advertising services, such as placing ads on websites, print publications, or media channels such as those found in TV programs or social media content. Event fees. This is revenue from organizing or hosting events, such as conferences, trade shows, or exhibitions. Professional fees. This is revenue from professional services, such as legal, accounting, engineering, or architectural services. You'll find revenue at the very top of the income statement, which is the first financial statement an entity prepares. It's usually shown as operating revenue, but sometimes includes other types of income. Here is Jollibee Food Corporation's income statement showing revenues and other income.
Cost and expense accounts. After revenue and income, we have the last category of accounts, costs and expenses. Costs and expenses are expenditures incurred by a business in the process of generating revenue or carrying out its operations. Think of it like the money a business spends to keep things running and to make money. Costs generally refer to the direct expenses related to the production of goods or services, such as raw materials, labor, and manufacturing costs. These are essential for producing the company's products or services. This includes the direct costs, also known as the cost of goods sold (COGS), which are the expenses directly related to making a product. For example, the cost of ingredients when you bake a cake is a direct cost. Expenses refer to the broader category of outflows related to the ongoing operations of the business, including both direct and indirect costs, which are the day-to-day operating expenses, like rent, salaries, utilities, and marketing, depreciation, and other costs associated with running a business. Think of it as all the other bills you have to pay to keep the lights on and get the word out.
Costs and expenses are measured at the amount you paid or have to pay for goods or services. Direct costs, such as the cost of goods sold, are recognized when the product is sold and revenue is earned, while operating expenses are recognized as they happen, not at the time when you pay for them. So if you get a bill in June for May's electricity, it's counted in May's expenses. Costs and expenses are used to figure out if the company made a profit or a loss over a certain period. They are deducted from the revenue, which is the money a business makes. Shown on the slide is a list of common groups of cost and expenses. Entities usually give a full breakdown of these in the income statement, including any big changes in costs or cost of goods sold, as already mentioned, refers to the direct costs incurred by a business in producing or purchasing the goods that it sells during a specific period. These costs typically include expenses such as raw materials, labor, and overhead directly tied to the production or acquisition of inventory. Sales and marketing expense refer to the expenses associated with promoting and selling a company's products or services, as well as activities aimed at building and maintaining customer relationships. These expenses are essential for driving revenue growth and increasing market share. Sales expenses include costs related to the sales team, such as salaries, commissions, and travel expenses, while marketing expenses cover costs for advertising, promotions, branding, market research, and public relations. Administrative expenses refer to the expenses associated with the general operation and management of a business that are not directly tied to production or sales activities. These expenses are necessary to keep the business running, but do not contribute directly to the creation of goods or services. Interest expense refers to the expenses incurred by a business for borrowing funds, typically in the form of interest paid on loans, credit lines, bonds, or other debt instruments. It represents the financial charge for using external capital, calculated based on the principal amount borrowed and the interest rate agreed upon with the lender. Tax expense refers to the amount of money a business is required to pay to government authorities based on its taxable income, including income tax, sales tax, property tax, and other applicable taxes. On the income statement, costs are often categorized into cost of goods sold, selling expenses like advertising, administrative expenses like office rent, and other expenses like interest. Also, expenses can be listed by function or nature, such as depreciation and salaries. Shown here is Jollibee Food Corporation's income statement, showing costs and expenses. There you go with the commonly used accounts usually found in the income statement. A summary of the account categories, their accounting treatment, and financial statement presentation is also provided in the Google Sheet provided earlier in the presentation by accessing the link in your module.
Chart of accounts in the digital age. As a bonus feature, let's talk about some pretty cool features in modern accounting that are changing how businesses handle their money. In the modern business environment, technological advancements have significantly transformed how a chart of account is structured, maintained, and used, and also how transactions are seamlessly done, especially with the integration of cloud computing, much like having powers on your fingertips. Automation and integration. With the rapid advancements in accounting software and digital tools, the traditional chart of accounts has evolved into a dynamic and interconnected system. These modern solutions allow the COA to seamlessly integrate with various financial and operational platforms, enabling automated transaction posting and providing real-time financial reporting. This shift toward automation offers numerous benefits. It significantly reduces the risk of errors caused by manually selecting account codes, accelerates financial processes, and ensures precise tracking of critical financial elements, such as expenses, revenue, assets, liabilities, and equity. Moreover, the rise of cloud-based financial systems has taken integration to the next level. Businesses can now effortlessly connect their COA with other essential systems, such as payroll, inventory management, and customer relationship management (CRM) platforms. This interconnected approach promotes efficiency, enhances data accuracy, and provides organizations with a holistic view of their financial health. Ultimately, automation and system integration are transforming accounting functions, empowering businesses to make faster, more informed decisions. Flexibility and customization. One of the biggest advantages of modern digital accounting platforms is the flexibility they offer in designing a chart of accounts that perfectly aligns with the unique needs of a business. Unlike the rigid, traditional chart of accounts that follow a fixed format, digital tools provide the freedom to create customized categories and subcategories with ease. This level of customization is invaluable for businesses looking to gain deeper insights into their financial data. It allows for more tailored reporting that can better serve different departments, teams, or business units. For instance, finance teams can create specific account structures to track the performance of individual product lines, monitor the profitability of various regional operations, or evaluate the success of distinct projects. By aligning financial reporting with a company's strategic objectives, businesses can make better informed decisions and respond more effectively to changing market conditions. This ability to adapt and customize accounting structures provides a competitive edge in today's dynamic business environment. Real-time data and analytics. In today's fast-paced digital era, businesses no longer need to wait until the end of the month or quarter to get a clear picture of their financial standing. With modern accounting systems, the chart of accounts provides access to real-time financial data, empowering companies to make quick, informed decisions when it matters most. But it doesn't stop at just having up-to-date information. Advanced analytics and artificial intelligence tools are revolutionizing how businesses understand and use their financial data. These powerful tools dig deep into financial performance, helping to identify patterns, reveal emerging trends, and even predict future outcomes. For example, AI-driven systems can automatically categorize transactions based on past data, significantly improving accuracy and saving time by reducing the need for tedious manual input. This level of automation allows finance teams to focus on strategic tasks rather than getting bogged down by routine data entry. By harnessing the power of real-time data and sophisticated analytics, businesses can gain a competitive edge, spot opportunities earlier, and navigate financial challenges with confidence. Enhanced collaboration and accessibility. Thanks to cloud-based accounting platforms, collaboration around financial management has never been easier. Multiple users can access and update the chart of accounts simultaneously, fostering better communication and cooperation across teams and departments. This level of accessibility goes a long way in improving how financial data is managed and shared. For instance, finance teams can seamlessly work together on reconciliations, while department heads can monitor their budgets without waiting for updates from accounting. One of the biggest advantages of cloud technology is its ability to support remote and global operations. Managers and executives can review key financial information from anywhere, whether they're working from home, traveling, or managing international branches. Having this real-time, transparent access to financial data enables leaders to make well-informed decisions on the fly and address financial challenges as they arise. Ultimately, cloud-based systems promote a more connected and agile approach to financial management, helping businesses stay responsive and aligned no matter where their teams are located. Improved compliance and security. Managing a digital chart of accounts comes with significant advantages when it comes to compliance and data security. Modern accounting systems often have built-in compliance features designed to keep businesses on the right side of tax regulations, industry standards, and legal requirements. One key benefit is the ability to receive automatic updates whenever tax laws or regulatory guidelines change. This ensures that businesses stay current and reduces the risk of non-compliance, something that can save both time and costly penalties. Instead of manually tracking changes to complex rules, finance teams can focus on more strategic financial activities. Security is another major advantage of digital COA management. These platforms are equipped with advanced cybersecurity measures, such as data encryption, secure user authentication, and automated backups. Such features help protect sensitive financial information from unauthorized access, fraud, and data loss. By combining compliance automation with robust security protocols, digital accounting systems offer peace of mind and help businesses maintain accurate, secure financial records in an ever-changing regulatory landscape. Streamlined reporting. Gone are the days of manually gathering and consolidating financial data to create reports. Thanks to modern digital accounting tools, businesses can effortlessly generate detailed and customized financial reports by simply querying their chart of accounts. With just a few clicks, companies can produce essential reports like financial statements, profit and loss reports, balance sheets, and cash flow statements. What used to take hours or even days can now be done in minutes, saving valuable time and reducing the chance of human error. The real beauty of these digital tools lies in their flexibility. Reports can be tailored to meet the unique needs of different stakeholders. For example, investors may want a high-level overview of financial performance. Regulators require compliance-specific information, and internal management might need more granular data to make strategic decisions. This ability to customize reports on demand empowers businesses to deliver the right information to the right audience at the right time, enhancing transparency and supporting more effective decision-making. Scalability and growth. As businesses expand and evolve, their financial operations naturally become more complex. This is where having a scalable and adaptable chart of accounts becomes crucial. Digital accounting systems are designed to handle this growth with ease, making it simple for companies to manage their increasing financial needs without missing a beat. One of the key advantages of these modern systems is their ability to accommodate a higher volume of transactions effortlessly. Whether a company is experiencing a surge in sales, expanding into new markets, or launching additional product lines, a digital COA can seamlessly adapt to the changing landscape. Beyond just transaction handling, these systems offer the flexibility to adjust to structural changes within the business. Need to add new business units or create specialized financial categories? No problem. Digital platforms make these updates smooth and disruption-free. This scalability ensures that as a business grows, its financial systems remain robust and aligned with its strategic objectives, providing the foundation needed to support long-term success. Cost savings and efficiency. Switching from outdated paper-based processes to modern digital accounting systems offers businesses a wide range of benefits, particularly when it comes to saving costs and improving efficiency. One of the most immediate advantages is the reduction in administrative expenses. There's no longer a need for endless stacks of paper, printing supplies, or storage for bulky financial records. Plus, digital tools help cut down on errors that often come with manual data entry, which can save money by preventing costly mistakes. But it's not just about cutting costs, it's also about working smarter. Many digital accounting platforms come with built-in automation features that handle routine tasks like bank reconciliations, invoicing, and expense tracking. By automating these time-consuming processes, employees are freed up to focus on more strategic, value-added activities such as analyzing financial data or exploring new growth opportunities. Ultimately, embracing digital accounting solutions allows businesses to operate more efficiently, save money, and make better use of their resources. All critical factors for staying competitive in today's fast-paced business landscape. In conclusion, information technology offers businesses a more efficient, accurate, and flexible way to manage their chart of accounts and financial data. The integration of technology has improved accessibility, compliance, collaboration, and scalability, allowing businesses to keep pace with the complexities of modern financial reporting and decision-making. Digital tools not only enhance financial transparency, but also empower businesses to make more informed, data-driven decisions that support long-term growth and profitability.
There it is. Chapter 6, all about the account, the basic units for recording financial transactions. Accounts are categorized as temporary, used for measuring performance and reset each period, or permanent, used for showing financial position and carrying balances forward. The account balance, which is the difference between debits and credits, is continuously updated through the running balance. Businesses organize accounts using a chart of accounts, which categorizes accounts into assets, liabilities, equity, revenue, and costs, using a coding system. The chart of accounts facilitates financial reporting, budgeting, and compliance. The lesson further details common accounts, their treatment, and presentation in financial statements, including asset, liability, equity, revenue, and expense accounts. Finally, the lesson highlights how technology has transformed accounting, introducing automation, real-time data, and improved compliance, which collectively enhance financial management and decision-making. Thank you for watching and catch you on the next chapter. Stay safe always.